In this video, I'll be diving into the ICT unicorn model, which is a high probability entry model. A lot of people get it wrong, so I'm going to show you guys when this model works and when it fails, and here's everything you can expect in this video. We need to dive into a breaker block first because you need to have a full understanding of what a breaker block is to understand the unicorn model. A breaker block is when price creates a low, a high, a lower low, and then a higher high. This is a bullish breaker block, low, high, lower low. On this lower low right here, all it has to do is break beneath this low. It can wick it, it can just go beneath it by one tick. The key idea here is that it just needs to go beneath that low. When price spools to the upside and it takes out this previous high right here, it needs to close above that high. And the reason it needs to close above it is because that's what validates it as a bullish breaker block. A lot of new ICT traders will just look for price to wick that level. It needs to close above it. That's important here. So low, high, lower low just needs to wick through this previous low. When price creates the higher high, it needs to close above this high. And why that's significant is because the last up close candle in here before price created that lower low, that's the bullish breaker block. Price needs to close above that last up close candle. That's what's significant here. So once it does that, that last up close candle can act as support if price is in a buy program. So typically price will retrace back into the breaker and then start to expand higher. So now let's dive into a bearish breaker block, which is the same exact thing flipped. Price creates a high, then it creates a low, then it creates a higher high, then a lower low. So we have a high, low, higher high, lower low. When price creates the higher high, it just needs to wick above this high. When it creates the lower low, or breaking through the breaker block down here, it needs to close beneath that level. The last down close candle in here before price creates that higher high and then that lower low, this last down close candle is going to act as the bearish breaker block. Price needs to close beneath that. Once it closes beneath it and price returns into it, this is the valid bearish breaker block. Price, if it's going to be in a sell program, will typically respect that, then start to head lower. So the unicorn model is when we couple a bearish breaker block or a bullish breaker block with a fair value gap. So now we'll be diving into a bullish and bearish fair value gap. I know a lot of you guys probably know what this is, so I'll go through it pretty quickly. A fair value gap is a 3 candlestick pattern. This is candle number 1. This is candle number 2. This is candle number 3. When candle number 1, the high of that wick, and candle number 3, the low of that wick, do not overlap each other. As you can see, this candle's low right here and this candle's high aren't overlapping each other. This creates an imbalance in the algorithm, and this is categorized as a bullish fair value gap, or a BISI, a buy side imbalance, sell side inefficiency. Think about it like this. It's a buy side imbalance because it only delivers to the upside here, and it's inefficient in sell side delivery. That's why it has the name BISI, or buy side imbalance, sell side inefficiency. So here's what a bearish fair value gap looks like. Price creates candle number 1, 2, and 3. Candle number 3, the high of that wick right here, does not overlap with the low of candle number 1's wick. So it creates this imbalance in the algorithm, creates a sell side imbalance, buy side inefficiency. This is a bearish fair value gap. So now the unicorn model, it's pretty simple. All it is a fair value gap overlapping a breaker block. So if price is already heading up to here and you're anticipating the draw on liquidity to be higher, let's say you're targeting an old high, when price returns to a breaker block and has a fair value gap overlapping that breaker block, that area will act as strong support most of the time and start propelling price towards that draw on liquidity. And don't worry, I'm going to give you guys some real chart examples and also me trading this model live. So I think the easiest way to find this is pretty much to just identify a breaker block. And once you identify a breaker block, just see if there is a fair value gap overlapping that breaker block. Here's a bearish unicorn model. You can see that price creates a breaker block. All price does is return back to the breaker block, and there's a fair value gap overlapping that breaker block. If the draw on liquidity is lower and you're anticipating for price to head down to here, that price area will act as strong resistance and propel price towards the draw on liquidity. And don't worry, I'll give you guys an example of when to know if the breaker block will work versus it not working. So now let's dive into a real chart example and look at a bearish unicorn model. So first we need to identify the breaker block. You can see that price creates a high, it then creates a low, then it creates a higher high. So it could just wick through that high, but we need to see price create a lower low and close below it. See this big down close candle? It closes beneath it. So we need to mark out the last down close candle, which is this big down close candle right here. You can see that this is the lowest down close candle. We're going to extend this out, and this is our bearish breaker block. When price returns to that, if price is still in a sell program, it's going to retest that as resistance before price heads lower. What do we do now? Now that we have identified the bearish breaker block, in order to identify the unicorn, it's pretty simple. Just look for a fair value gap on the same time frame overlapping that price area. We could see we do have a bearish fair value gap right in here. You can see that the fair value gap overlaps the breaker block. This is a bearish unicorn model. Why can we expect price to continue lower? Well, because there is all of this engineered liquidity beneath us. You can see that it has these relative equal lows right here, and it also has these relative equal lows over here. You can see that price took out buy side liquidity by breaking through these old highs. Doesn't look like it takes it out, but it takes it out by one tick. So buy stops were purged. It creates a bearish unicorn model to the downside, and there's engineered liquidity below. So for stop loss placement, there's a few different ways that you could do this. You could either have your stop above the very high of the swing high of the breaker block, or you could have your stop loss above candle number 2 of the fair value gap, which is right here, or you could have it above candle number 3 of the fair value gap, which is at the very high up here. Some people do have it just right above the breaker. That works too. Typically price won't trade all the way up there. You can see when price taps into the fair value gap and the breaker, that area acts as strong resistance and price heads straight for the sell side liquidity. Before we do continue, if you guys would like to see more educational content regarding ICT concepts, I do have a Discord, which I will leave first link down below. I do cover these ICT concepts real time. You can see this was a setup from today on the NASDAQ. We had this bullish order block right here, and we were in the reaccumulation phase of a market maker buy model. I was looking for this order block to act as support and then start expanding for the buy side. You can see that price took out this first high right here, took some partials above there, and then it heads for the buy side, and that was the full TP above there. So I do call the market real time on ES and NQ. There's also much more, cover exclusive videos, and I do cover other assets. If you guys are interested in that, check out that first link down below. So now let's dive into what a bullish unicorn model looks like. We need to first identify the breaker. So we look for a low, a high, a lower low, then a higher high. The last up close candle before price creates the lower low, then the higher high, is the bullish breaker block. When it creates that higher high, it needs to close above it, which we do have right here. When that happens, we can extend out the last up close candle, and we can mark this as our bullish breaker block. It's very simple to find the unicorn model now. All we need to do is identify a fair value gap that just overlaps in that breaker block area. It does not mean that it has to be fully in it. In this example, it is. You can see that the fair value gap is inside the bullish breaker block here. It does not have to be like that. It could just be overlapping by one tick, and then it's considered to be overlapping the fair value gap and the breaker block, so it'd be considered a unicorn model. So this is a bullish unicorn model. We have a fair value gap and a breaker block overlapping in the same area. Price returns back to it. Since the bias is bullish, price respects that as support and then continues higher. And you can see that it eventually delivers up to buy side liquidity. So now let's dive into an example of when a bearish unicorn model can fail. As you can see right here, we do have a bearish breaker block. You can see that we do have a bearish fair value gap. They're both aligned in the same area. Price pulls back up to it, it rejects it for a little bit, but then it pulls back down, rebalances the fair value gap, and then continues higher. How can you not get stuck offside on this? And the way you do that is having a bias and narrative. So as you can see on the 4-hour time frame, we have this old low over here. Price comes back down, takes out that old low, which is sell side liquidity, and then starts to displace higher. So this last up close candle before price creates a lower low, then a higher high, this is the bearish, or this is a bullish breaker block. What do we also have in that area? We have a very small fair value gap. So this is a bullish unicorn model. Price takes out sell side liquidity, creates the bullish unicorn model. Price is respecting that, right? It's coming back down, taking out internal levels of sell side liquidity. So we have internal range liquidity, then price starts displacing higher. Because we have all of this, it's indicating that smart money is long, and they're going to want to start taking out these levels of buy side liquidity. So when price is in a buy program and it's targeting old highs, bearish unicorn models will fail. And the reason that is because smart money is already long. They're targeting old highs to sell to buyers at a higher price. So there's no reason for this bearish unicorn model to work because smart money's long and they need exit liquidity. So they're going to be targeting this high. And the reason they're targeting that high one more time is because price took out sell side liquidity, created a market structure shift higher, has a unicorn model, so it created a breaker block and a fair value gap, and then it starts displacing higher. These are all signs that the algorithm is in a buy program and it's going to want to take out these highs. That's why this bearish unicorn model fails, because price is in a buy program and not a sell program. If price were in a sell program, this would work. So I'm going to show you guys a live execution of me trading the unicorn model. Before we do that, here's how you draw a standard deviation on the unicorn model. All you're doing is drawing it from the low of the breaker to the high of the breaker. Price can start targeting these standard deviations to the upside. I like the -2. Price will typically target that, but you need to have a bias that price is already heading for buy side around that area. If you were to flip it, same exact thing goes. You're drawing it from the high of the breaker down to the low of the breaker. Then price can target these standard deviation levels. So here's a live execution of me trading a unicorn model. I'll leave it in the description down below so you guys can check it out if you want. I did post it on my Twitter. But here's what it looks like. You can see we have a breaker block aligned with a fair value gap. So I entered a little bit early on this one because I wasn't necessarily trading the unicorn model. I was just trading the fair value gap with the market structure shift. But price did retrace back down, retested the fair value gap with the breaker block. That would be the entry, stop loss at the low down here. And then you could draw the standard deviation from the swing low down here to the swing high of the breaker. If the -2 and -2.5 is aligned with buy side, price will typically target that. So that's where I was targeting. You can see that I took a partial up here, and then I was waiting for price to start targeting buy side liquidity. And you can see I did take my final position off at this high up here. It does end up in that -2 to -2.5 area. And this is what a clear unicorn model looks like. And I'm showing you guys this because I don't just talk about these models. I actually trade them live and I do discuss them in my Discord. That's going to be it for this video. Hopefully you guys enjoyed. Hopefully it was insightful. I'll see you guys next time.